Welcome to the Everyday Investor podcast. Please forgive this AI-generated introduction, as I've been having tech issues this weekend. If 2023 was the year that residential property prices in New Zealand took a breather, is 2024 the year where things get back to normal? As far as investing is concerned, for many, property is our drug of choice. It's also what our economy appears to be built on. Property lending facilitates the steady stream of credit creation that keeps the entire scheme running. In the past, we could scrape together a small deposit, buy a house, wait for it to appreciate in value, and then use that capital gain to borrow more, to buy more. Banks lent on our income, equity, and our likelihood we would pay it all back. As time goes on with property, however, more wealth accrues to fewer hands. It's a feature or flaw of the system, depending on your perspective. Today, I'm talking with Kelvin Davidson, Chief Property Economist at CoreLogic, about interest rates, property prices, and debt-to-income ratios. Optimism is returning to the market as interest rate drops may be on the horizon. The bottom may be in. It's early days, and we're not out of the woods yet, but those thinking of selling this year or buying should pay attention to the pieces falling into place. Let's get started on today's show.
You're listening into the Everyday Investor podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started.
All right, welcome to the Everyday Investor podcast, everybody. My name is Darcy Ungaro. Today I'm sitting with Kelvin Davidson from CoreLogic. How are you, Kelvin?
Very well. How are you?
Very good, very good. I know that you work with CoreLogic. Just introduce yourself. What do you do?
Yeah, so Kelvin Davidson, I'm a chief property economist at CoreLogic in New Zealand. So I'm part of the research team. We are basically paid to talk about property to anybody who will listen. So we sort of do three key strands of work. It's talking to media, it's presenting to clients, and writing research reports. So you're using our data where we can to promote the business, but also just really educate and get information out there about the property market, because as you say, everybody's got a stake in it, whether you rent or whether you own property, you're still very interested. You got to live somewhere.
Now, a lot of the people that I talk to and a lot of people that listen to the show are primarily interested in property because, rightly or wrongly, and wrap it up in any way you want, but it's about number go up. We want to know whether the property values over the long term will go up. And for those that aren't in the property market, or they want to get more into the property market, they want to know if it's reached the bottom of some sort. So how helpful is data really in predicting tops and bottoms?
Yeah, well, I mean, you got to measure something before you know what's going on. So certainly data's vital, and we publish a CoreLogic House Price Index every month, which does just that. It looks at the property market in general, but also right down to TA level. We've got even figures that go down to suburb level. When a big part of CoreLogic's business is automated valuations on each property every week. So we can build up that information to use to assess the state of the market. But also we have our house price index, which is slightly different from automated valuations, but sort of does the same thing: assessment of where property values currently sit based on recent transactions, but also a wider range of information which assesses value right across the stock of property rather than just what happens to have sold right now, because that can be affected by what's happening. What is selling? Is it apartments or houses? That could skew data. So our house price index looks across the market as a whole, and we've certainly seen in the last couple of months that values have started to rise. We measured a peak to trough fall of about 13%, and they've started to turn around by kind of 1 or 2% in the last few months. So I think it's pretty safe to say we've passed that trough now. Of course, an average house price it's useful, but it doesn't tell you anything like the full story, because nobody buys the average house. You're buying an individual property in an individual market. So I think it's important to say that even though I think we're on that recovery phase, it's a bit patchy still. It's not everywhere has recovered yet. We're certainly seeing strength from, say, the main centres, Auckland, Christchurch. But on the last reading, areas like Gisborne, Napier still fell a little bit. So there's still that idea of patchiness here. And I think that could last into 2024. We're kind of expecting that it won't be a straight line recovery. Some months will be stronger than others. Some regions will be stronger than others. So I think that's an important thing to point out too, is that there's still a bit of patchiness below the surface. It's kind of all one-way traffic just yet.
So when you say that there was roughly a 13% fall last year, according to the house price index, and it's kind of up by 1 or 2% now, these are nominal prices, right? So this isn't adjusted for inflation at all.
No, that's just a face value, dollar value, nominal price. So no inflation adjustment in there, which of course you could do. And we know inflation's been pretty high, so that would reduce the numbers. But yeah, there's just a face value dollar price.
And so it has been like when you do adjust it for inflation, it has been quite a significant pullback in prices when you overlay that inflation data. But I guess the main story is that from 13% negative to around 2% positive, that shows quite a significant change in direction. And I guess the question is, like you say, it might be a bit patchy this year. The question is whether that comes with it some momentum, because I guess if the masses, this is, I guess, the part where the data doesn't really carry us far enough, right? Doesn't really necessarily capture what the masses might be thinking and feeling, and therefore capture sentiment, right?
Yeah, that's right. There's a couple of things I'd add there. And it's one thing, so we saw that fall from the peak of about 13%. It's recovered 1 or 2%. But after post-COVID, so we're sort of talking from August, September 2020 up until the end of 2021, we saw growth of about 40%. So it was a huge spike. We all know about it. Interest rates collapsed, all these things. And so if you look at where prices currently are compared back to pre-COVID, we're still up sort of 25, 26%. So it's an important thing to keep in mind. If somebody's owned property over their whole duration, yep, a little bit might have come off the top in the last little while, but they're still well ahead of where they were pre-COVID. So that's important context. And then, yeah, I mean, in terms of the drivers we've seen lately, and mortgage rates, they haven't come down massively. They're starting to creep down, but I think the key thing is that they've stopped rising. So that means that people have been able to sort of quantify what their worst case looks like, gives them a bit more confidence to start trading again. We've seen those LVR rules loosen a little bit, triple CFA. Migration's been really strong. The labour market's still been supportive. So those things have started to turn the market around. But in addition to all that, like you allude to, psychology is important, confidence, mindset, and that just seems to have turned around. I was pretty pessimistic for a while there. People started to expect house prices to fall, and so they did fall. And of course, there's fundamental drivers too, but psychology plays a big role. And I think now that's turning around. I guess it just adds that little bit of layer of momentum, expectation, whatever you want to call it, on top of those fundamental drivers. So, yep, I mean, just right. It's hard to measure. There are some measures out there of sort of housing confidence and what people expect in terms of house prices. But when it does look like that's turned around, and when you add that on top of those fundamentals, yeah, I think we're into that recovery phase.
So one of the things that works when I say one of the things that works, it's a bit debatable, but one of the things that might work, according to some people, no matter what the market is technical analysis. And that's where effectively you're kind of reading tea leaves by looking at trend lines and patterns of prices over time. Does that ever come into the play? Because you guys have access to so much data, do you kind of ever look at it just from reading the tea leaves, so to speak, and kind of looking at trend lines and predicting what might happen based on what's been?
Yeah, to some extent. I mean, there's you often see articles, not often, sometimes there's a bit of a cycle where they come up from time to time where people say, okay, house prices have doubled in the past 10 years. So that's the next cycle. They're probably going to double in the next 10 years. And maybe they do, maybe they don't. I've got to say I'm a bit cautious about that. I mean, you can run those long run averages. Okay, growth has been 6 or 7% per year historically. So let's assume that continues in the future. That kind of thing does happen. I wouldn't say it's something I do necessarily. I mean, we might see that kind of growth in the future, but it doesn't happen by magic. There's always going to be a fundamental driver for it. And long term, we've seen a long-term fall in inflation, long-term fall in interest rates. And that's been a really key reason why house prices might have doubled every 10 years or so. So if you look forward from now, well, there has to be a reason why house prices do and it's hard to see interest rates having that same impact in the future that they've had in the past. So I have to say I'm a bit more cautious about the future in terms of long-run house price growth. If it's been 6 or 7% historically, in the future we might be looking at 3 or 4%, something like that. So probably where we would tend to go into that is more around sort of housing affordability. So we'd look at things like house prices in relation to incomes, look at a trend line there and see where house prices currently sit in relation to incomes and how that sits in terms of a trend, historical perspective or, a long run average. Things like mortgage payments as a percentage of incomes, where they currently sit in relation to normal. And that kind of gives, I mean, housing affordability doesn't tell you everything about where the next cycle might go. I mean, there's been plenty of episodes where housing affordability's look really stretched. Yeah, house prices have continued to rise. So it doesn't tell you everything, but it does. I think it does sort of set the scene. And right now, housing affordability measures are pretty stretched in relation to where they would normally be. So I think that does just add to that idea that from here on, house price growth probably does need to be a little bit more subdued. Might not be, but when you look at those fundamentals, that's kind of where you sit. So yeah, it's maybe not that sort of technical trend analysis that you might see in sort of equity markets or whatever, that's those sort of moving averages. But yeah, there is a sense that the history can tell you something about the future for sure.
You mentioned mortgage payments as a proportion of income. Obviously, it's probably easy to look at your income and then look at the actual house price, the nominal house price. But we're kind of talking about two different things, two different categories. One is cash flow, one is statement of position. So already there's a disconnect there. But it makes a lot more sense when you look at what a mortgage payment is relative to income. So if it's, say, at 50% right now, and the average is around 37 to 38 or more or less, which to me, that kind of feels quite right. Anywhere between 30 to 40. 40 is kind of what I tell people on the high side that you might want to aim for to get started with. Well, that seems about right. But the interest rates is the one thing that we can kind of look at with a bit more hope that it might come down. Because the prices of the properties, which is the other part of that equation, because that determines how much debt you have, that part, well, that might be kind of done as dash, right? Like what we were talking about before, we might be at the bottom in terms of where house prices are. Perhaps this year it could be patchy, like you say. But with incomes due to inflation adjusted incomes, well, that's probably going to keep on going up a little bit, right? So we might find that equilibrium again, right?
Yeah, I think there's a lot of moving parts in there. I mean, I'd expect the adjustment to take place, as you said, not much through house prices because they look to have reached that floor. The adjustment is probably reflecting some kind of combination of some income growth that sort of creeps higher over time, so that can help restore affordability and really mortgage rate falls. Now, I haven't run the numbers on what sort of mortgage rate fall it would take to get back down to average, but most people's assumptions for a pretty standard mortgage rate over the long run could be in that sort of 5.5%, 6%. So if we get some income growth over a 2 or 3 year period, mortgage rates sort of ease back down over that same period, housing affordability will look a lot better. But yeah, it's just pretty stretched right now, and that's simply reflecting the position for mortgage rates that we've got.
That's what makes it fun, right? Because there are cycles to the property market in so many different areas, and so if you're looking to get into the market, then it's hard right now still because of what you were saying before, because of interest rates makes that ratio really high. But if you can stretch and get in, there's a pretty high odds-ish. No one knows the future, of course, but there are high odds that things will become easier. So if you were pushing against the limit right now and you think you can afford it, then fill in the blanks, not financial advice, of course. Let's move on though to this year, because there's going to be a couple of things that will influence house prices. On balance, you're thinking it's going to be patchy though, right? Like it'll be an underwhelming upturn in 2024, but let's break down some of the reasons why it could be an underwhelming upturn and some of the little nuances around what could push prices up or down. Starting with tax changes, because this is probably more, the tax changes here that I'm referring to would be the tax changes that treat property investors just the same as any other business owner, where they can deduct the interest expense as a tax deductible expense, which is consistent across any other business activity. If there's expenses incurred in the course of deriving a revenue, you should be able to claim those expenses, interest being one of them. So that's going to be changed progressively with this new government. So how much of an influence do you think that will be in terms of the demand side for property in 2024?
It's certainly worth taking note of for sure. I mean, I guess in a really quick sort of overarching view for that underwhelming upturn that we've got, I think it's really, and we've touched on all of these things already, it's because affordability is still stretched, mortgage rates are still quite high, and there are these macro-prudential rules coming into play, which we'll touch on, but there's those kind of restraints on growth. So I think we'll see house prices continue to rise, but there are those restraints. Now, within that, there's lots of other different things going on, and we have seen first-time buyers have been really active over the past year or so, pretty strong share of the market. On the flip side, mortgage investors finding it a bit tougher, and that's reflecting some of these rules. And the loss of interest deductibility is definitely one of those. Now, investors have still been looking at new builds. That's because you can continue to claim that interest deductibility. So that's been a clear target for investors. But we get into the new tax year, 1st of April, as we understand it right now. We've got to get the full details yet from the government, but it looks like interest deductibility will go back to 80% if people are buying existing properties, and whether you're a new or existing investor. So, there are views out there saying that 80% is as good as 100%. You can get most of your interest costs deducted for tax purposes. So I think that'll bring some people back to the market for sure. When you also look at things like rents are rising now, so that raises the appeal of property investment. We know that the Reserve Bank's announced the loosening of the LVR rules proposed from middle of the year. And also, potentially mortgage rates starting to creep a bit lower as well. So all of those things feed into the mix. And interest deductibility is definitely a big part of it. And we know anecdotally that a lot of people have held back from buying investment property because of that. And it is changing the sums pretty significantly. Thousands of dollars a year in extra tax that people have had to pay. So that's now wound back. Then that's a real cash flow boost. So pretty significant. But I'm cautious. We're not really anticipating a flood of property investment, because still ultimately rental yields are relatively low and mortgage rates are still relatively high. So that the top-ups are quite significant, whether you have a smaller tax bill or not. So I think it's, things are shifting towards property investment. It's been pretty tough for a while. Things are shifting, but it might just take a little bit more to really tip the balance.
Okay. Connected to the tax piece would be the change to the bright line rules. In my view, to me, that kind of feels like those that are under stress, financial stress, and I've certainly seen a lot more in 2023, but those that are under financial stress because of interest rates primarily, if they want to sell, there's a little less in the way for them to sell their portfolio of investment properties. So that's on the supply side, introducing more supply into the market. Do you feel that's going to be a significant impact? I know volume will probably come before prices go up, but do you think in the short term that could depress prices a little bit or keep prices subdued?
Yeah, I mean, that's possible. I think probably, and as you've alluded to, I think this is probably more about a liquidity thing. This is about some more deals coming to the market. So there'll be investors out there, no doubt at the moment, sitting there on cash flow losses, having to top these properties up, but thinking, well, I'm sitting on a pretty big capital gain too. I don't want to have to pay tax because that would be worse. So just getting through until that bright line test passes. And if these changes come through from the government, well, they're going to be off the hook for capital gains tax a lot sooner than what they might have been. So I think, we'll see some more listings come forward when that date passes, I suspect, freeing up some properties to be purchased. So I think that's what I mean. There'll be a liquidity effect. We'll probably see some more transactions. I suspect there's probably going to be demand there to meet it, though. First-time buyers still out there. other investors who are perhaps in a stronger sort of equity position looking to buy into that market that might be just rising again. So yeah, I think we'll probably see a liquidity effect rather than prices. I expect a big demand there to mop up those properties. So, estate agents potentially happy, a few more listings coming forward and a few more sales happening.
I agree. And I know real estate agents will be really happy to hear that, because it's been hard as interest rates got lower and lower and lower. That just makes it harder, because it makes it easier for people to hang on to their properties and they don't need to sell. But over the last couple of years, we've seen the reverse for the first time in a long time. And the magnitude of that caught me off guard. But what really surprised me even more than how much interest rates rise was just how well people were able to hang on. But I know some people are just hanging on by the skin of their teeth. So if it's a property investor, they might be more likely. Anyway, 25% or so is the share of sales that have gone to first home buyers. Correct me if I'm wrong. And that's up on previous years, but that's down on 2021, I think, and sooner or before. Is that correct?
Yeah, I mean, when we talk about sort of by our buyer classification, these numbers come from. So CoreLogic's buyer classification series, we break it down into who's purchasing property. Is it an investor, a first home buyer, a relocating owner occupier? And we've certainly seen a strong market. So there's two things you look at. One is market share. And over the calendar year 2023, first home buyers had about 27% of activity. So pretty high. The previous record was more closer to 23, 24%. So it's been a record year basically for first home buyers in terms of market share, but number of deals has been a bit lower. There's been quite a few years in the past where the number of first home buyer purchases has been higher. So you got to note both sides of the equation here, I think.
Yeah, no, I get it. Okay, well, let's move on to interest rates, because in my mind, that interest rates is number one in terms of influencing property prices, because that influences the cost, which is the mortgage bit, and that's that 50% number that we talked before. So no one knows how interest rates will actually shift this year, and if they will, to the extent that some think they will. But what are your general views, like thinking about next year, this year, in two halves, the first half and then the second half? Do you feel like we're going to see any significant reductions to interest rates in the first half of this year?
Yeah, so I just start off this by saying I think you're right. Financing costs and the sort of credit environment, I think that's been the experience post-COVID. It's just reinforced this idea that credit availability and credit cost is really the key driver of the market in the short run. Now, how you define the short run is up for grabs, but I think it is that really key driver. And yes, housing supply, property population growth, property demand, these things matter in the long run for house prices. But I just think what's been reinforced since COVID is that it is really about credit conditions. So yeah, big focus on mortgage rates this year. I think first half of the year, yeah, it's still a bit soon to see any significant shifts in mortgage rates, because we know inflation, it's coming down, but the rate is still above target. So the Reserve Bank will really want to get that back in the box before they even start entertaining the idea of cutting the official cash rate, which would then take some heat out of mortgage rates. Now, obviously, other things matter for mortgage rates. It's not just the official cash rate, it's what's happening offshore as well. And that probably matters more even for those longer term fixed rates. So lots of moving parts. But in terms of the general interest rate environment, I think we need to see inflation really get back into that 1% to 3% range before you start to think about mortgage rate cuts. And it probably is, but I think it's becoming a much more likely story for the second half of the year. That's where I think we'll have inflation back in the box, and that's where we might start to see some more appreciable falls in mortgage rates. Now, from the Reserve Bank's perspective, they don't want to signal that now, though, because they signal that now. Financial markets move sooner, and you see mortgage rates come down sooner. It's probably not quite what we need right now. Yeah. So I think we're probably in a situation where the Reserve Bank I've seen it called this over the past few days, deny, cut. As a surprise, one sort of signaling it before you get there. So yeah, I think getting into the second half of the year, inflation's under control, and that's where mortgage rates could start to come down a bit more appreciably, and getting closer to that sort of 5.5%, 6% kind of normal figure. Don't bank on 2.5% again anytime soon, but getting back to that more normal figure, I think, is where we'll be trending towards second half of the year.
We'll put that in stone and then hold you accountable to that prediction there, Kelvin. How's that?
No financial advice.
No, of course not. Just crystal ball gazing, right? Slight tangent. again, going back to the fact that you guys are the masters and commanders of all property data everywhere in the world, slight hyperbole, of course, but is there a measurement or is there an index that tracks the rent relative to the cost of ownership? In other words, is there an index that sort of captures how much it would cost to rent a home versus buy that exact same home and fund, say, 80% of the purchase price?
Yeah, those calculations at face value sound like they could be quite simple. And you do see a lot of analysis which simply looks at what would it cost me to rent this per week right now, $500 versus how much I'd be paying on the mortgage. And that sort of face value cost comparison right now is easy to do. And at the moment, it does come out very much in favor of renting because it's so much cheaper. But it's really not as simple as that. The lifetime costs of renting versus the mortgage, that's where it starts to get pretty complex. You add in, rates and insurance, those sorts of things when it comes to ownership. But at the same time, you're building some equity in a property, you've got that security of 10 years. So I remember doing this back in one of my previous jobs 10 or 15 years ago, trying to go down that rabbit hole, and it got very, very complex. And you start to add in inflation and opportunity cost and all of these things. So it's a very, very tricky concept. But there might be measures out there. It's not something we necessarily maintain because of that complexity of it and that life cycle of property ownership. But right now, if you want to just look at a simple measure of paying rent versus paying mortgage, it does come out pretty easily in favour of renting because mortgage rates are high, but doesn't take into account any of those really important things, security of tenure and building equity, that sort of thing. I mean, paying a mortgage is forced saving, really, isn't it? That's the key thing about it.
Yeah, no, but it's good to know though that it's not just because I've been trying to kind of figure out how could you create an index that measures that so that, hey, when it's over 1, it's favorable in the short term to rent. When it's under 1, it's favorable to buy. You can do a test yourself case by case, and it's probably not that hard to figure it out, but it is interesting because a lot of people will form their house purchasing decisions based on immediate affordability. Not everybody. In fact, there's a bit of a lag. It seems to take a while before people realize, wow, it's actually way cheaper to own a home now than it is to rent. And the opposite is true as well. And people are starting to realize now that, renting is far cheaper than owning that exact same home. But it would be good just to kind of, I think, have a data point where you could say, hey, this index looks like this. So adjust your thinking a little bit sooner. But let's shift now, talk about what might be a bigger influence in the future than what it is today. Just this week, we've seen a little bit more come out of the Reserve Bank regarding debt to income ratios, or DTIs. And we love the 3-letter acronyms when it comes to central banking, and or not just 3-letter acronyms, they'll go for any letter acronyms really. But so I'm just going to read a little bit from a statement that came out from the Reserve Bank just last week. DTI restrictions, which sets limits on the amount of debt borrowers can take on relative to their income, will complement other tools we use to support financial stability, including LVR restrictions on residential mortgage lending. So just to break this down for people that might be unfamiliar with these 3-letter acronyms, DTI stands for debt to income restrictions, and LVR restrictions stands for loan to valuation restrictions. So one tool restricts the amount you can borrow based on how much income you have, and the other one restricts your borrowing power based on the amount of deposit or equity that you have already. So in your view, starting with the LVR restrictions, Kelvin, which has been around for obviously a lot longer, do do like it helps create the financial stability, or does it, and has it in the past, risked financial stability?
I mean, I'm going to sound like a typical economist here and sort of sit on the fence. It's hard to know the counterfactual. So obviously we've had LVRs in place in New Zealand for a decade or so. We really don't know what would have happened without the LVRs. So that's me sitting on the fence a little bit. But I've got to say, I think there's been a tendency, I guess, in Western countries to have these big boom and bust cycles in house prices and credit growth. So, for me, I just think a little bit of control probably isn't the worst thing. And yes, there's probably been times where certain buyer groups have been unfairly, maybe, or I'm not sure that's the right word, but perhaps been unable to purchase because of LVR rules when otherwise they perhaps should have been able to purchase. Maybe they could afford to pay the mortgage, but haven't been able to raise the deposit. Yeah, that's probably been the case from time to time. But generally, my sort of gut feeling on LVRs is they have probably put us on a more stable housing market footing than we might otherwise have been. It means that people have got to do a bit of skin in the game. They've got to put in a deposit. It's going to take a bit of time to save their money. And so I think it probably has stabilised our housing market a little bit compared to what might otherwise have been the case. So, and of course the Reserve Bank's been, I think, fairly reactive in terms of changing those LVRs when it's been obvious they've been too loose or too tight. They've been pretty proactive in terms of changing them. And of course, we've got another loose thing probably coming up in the middle of the year, which will just make it a little bit easier for people to get it into the market if they've got low deposit, whether they're a first-time buyer or an investor. So, on the whole, I think LVRs have probably done a reasonable job, but there probably have been times when certain groups have been prevented from buying when perhaps they shouldn't have been.
Yeah, no, well said. I think like the side effect has been inequality, or a tighter and smaller group of people being able to make moves at the expense, in a sense, of others, because house prices could have gone up more. So my general view, like coming probably from a little bit more of a libertarian bent, I'd confess, would be that as soon as you put more regulations in place, it actually exacerbates the problem over the long term and creates more complexity. But so be it. Now we have another one potentially coming out, debt to income ratios. So the idea here is that if you're a residential borrower, you would be able to borrow up to a maximum of 6 times your income. If you're a property investor, 7 times your income. I did some calculations to discover that interest rates would have to drop, or the servicing stress test that the banks use would have to drop quite significantly before the debt to income ratio restrictions actually bite. So it's not going to be an immediate impact. But what's your general view, Kelvin, on debt to income ratio restrictions?
I guess for me, there were probably 3 key points coming out of that latest release. One, no major surprises. We've always thought that DTIs would come in and they'd operate alongside LVRs. So the Reserve Bank's always said that they think LVRs kind of protect the banks because it means the borrowers have to have a bit of skin in the game in terms of a deposit, whereas they see DTI rules protecting borrowers. So say, okay, we want to just limit how much debt you can take on because we don't want you vulnerable to potentially higher mortgage rates in the future. So I guess that first point, no major surprises in terms of what was announced or the timing. Second, absolutely, they're probably not going to do much, though, in the first instance, because at the moment, higher mortgage rates are certainly doing that, where serviceability tests are limiting how much people can borrow in relation to their income. And the Reserve Bank acknowledged that in their statement too. They pretty much said, hey, we don't actually think they're going to do much either, but it's more about the next cycle. It's about when mortgage rates do fall, that's when DTIs could kick in. So, yeah, that was number 2. The third thing I'd say about DTI rules is that it is about the long run. It's about tying house prices more closely to incomes, which we perhaps haven't seen so much in the past. Now, still be cycles. You still have growth in house prices above wages for a while, and maybe periods where growth is a little bit below wages. But over the long run, it should tie house prices more closely to incomes, and it might not improve housing affordability, but should prevent it getting massively worse in future, potentially. There's other factors there like housing supply and population growth, these types of things, but it will tend to tie them a bit more closely to incomes. And I guess from an investor's point of view, if people are already tapped out on debt, it does limit how many properties people can own in a shorter period of time. The way that you continue to grow a portfolio is through income growth. Now, that takes a bit longer. So it does sort of slow down an investment journey, I suppose, because if you're already at those DTI caps, the way you can buy more is to grow income. That might take a little bit longer. So it doesn't prevent property investment by any means. It doesn't prevent capital growth. All of these things are still there. It might just take a little bit longer. So that's what the Reserve Bank wants in terms of stabilising the financial system. So it's a pretty big landscape shift. Not surprised that those changes were announced, but it does. It's not something that's going to kick in straight away. It's more about that when that next cycle when mortgage rates fall. And in fact, I suppose if you want to look at the changes that were announced in the whole, as a net package, that it could actually be a little bit of a boost to the property market in the second half of this year, because DTI is probably aiming to do anything anyway, but they're sort of neutral at the start. The other side of the equation is looser LVRs, so that's going to provide a little bit of boost to the market. So in net terms, I think it's this package, if you want to call it that, is probably a little bit of stimulation for the market second half of the year.
Because of the LVR restrictions, and like you say, the DTIs won't necessarily bite until later on. So all things Reserve Bank, I'm generally a little bit critical on, more than I should be. So forgive me, Reserve Bank of New Zealand, but that's just kind of just how I roll. I see this as being quite punitive in terms of property investors. I think it's a bit of a shame for those that are trying to build a portfolio, but I guess in the new world that we're in, that's kind of, unfortunately, you're still going to be public enemy number 3 or 4 at least. Maybe not number 1 like we have been, but that's a factor. So it's going to slow down property investors. What do you think, though, about the biggest risk that I haven't heard anybody talk about yet, but I think this is actually somewhat concerning, is this centralization of banking authority, or the discretion now being further stripped away from the retail banks that you and I would deal with, and now it's going further up. So already the Reserve Bank controls interest rates. They now control how much equity you can use, so they control the amount of deposit that you need to use. And now thirdly, they're the ones that will be controlling how much income you need to borrow the amount. So those are the 3 things that traditionally most retail banks would have done in more of a decentralized, based on their own discretion at the grassroots, making exceptions where appropriate, stopping people from getting into debt where it was appropriate. Now that's being stripped away, and now we have this rules-based order system at a centralized place. Do you see any harm in that?
Yeah, I mean, I suppose I'll just 2 things I'll raise here again. And the first, I'd also say, we still need property investors, absolutely. So rules that make it more punitive. I'm not saying that these necessarily are, but you do have to acknowledge that we need property investors. We've got massive net migration at the moment. There's been a period where property investors haven't been able to be as active, and I think we're probably seeing those effects coming through a little bit now with the rental stock not having been replenished as much as otherwise would be. Supplies a bit tight. At the same time, we've had a big inflow of net migration, so demand for rental properties is high. What are we seeing? Strong rental growth. So I think, we obviously need, there's going to be demand for rental properties in the future. So we need property investors. I think that's probably not a particularly controversial view, but I think worth acknowledging. And as for the sort of banking regulatory environment, I suppose, banks obviously have their own internal testing, and from time to time, some, I think, have been running kind of loose internal DTI policies anyway. So you might say, this is the Reserve Bank just formalising things that might already be going on, because ultimately banks don't want to be advancing dodgy loans, because it's going to come and bite them ultimately. So the incentives are kind of aligned, but I try to stay sort of pretty neutral on the political sort of stuff. The Reserve Bank has been taking on more and more responsibility for all these things over the years, and which perhaps hasn't been there in the past. I guess it's not unique, though, I suppose, in the sense of more regulation coming into the property market. I guess maybe that's just a different model. I mean, in Australia, the Reserve Bank of Australia is responsible for monetary policy. They do have a financial regulator that's called APRA, and they monitor things like financial stability risks on the property market. So there is oversight there. It's just done within a different agency, whereas here, that's all centralised within the Reserve Bank. So it's not unique in the sense of, I think other countries do have regulation. It's just maybe it's split out into 2 or 3 different branches of government as opposed to the one here. So not sure whether it's good or bad. I mean, it's the reality of what we're looking at now, and to some extent, it probably does just endorse what has already been happening in-house at some of the banks. But it's going to be interesting to see how it plays out.
I think so too. I think it's something that, like, I guess the main thing that I would worry about is in the future is that there is one centralization of this banking discretion that has to be quite a strong authority to actually maintain the financial stability that it says it's driving at. So more decentralization to me sounds more stable, because you're giving yourself a wider stance and you're distributing it. But so be it. That seems to be the way that we're going. Do you feel like, back in March 2020, the reaction to what we were going through with that health event, easing of the LVR restrictions, do you see that to income ratios could be one of those things that the Reserve Bank might trip over in the future if there is another shock which requires more stimulation from the banking sector and lowering interest rates and then encouraging more borrowing? Do you think these DTIs could get in the way?
Yeah, possibly. I mean, harking back to March 2020, it's, hindsight's perfect, of course. And I mean, at the time, let's face it, who knew what was going on? It just felt pretty bad. So I think at the time, probably most people were pretty happy that, lending rules are being loosened and interest rates are being cut. I think in hindsight, we now know, maybe it was a bit extreme. Those low interest rates triggered, excess spending, which triggered the inflation we've got now. And perhaps, in hindsight, we might do things a little bit differently. But like I say, hindsight's, the perfect 2020 vision. So hard to be too critical, I suppose. In terms of looking ahead, yeah, I mean, it's possible that DTIs could become too restrictive at certain points in time, just like maybe LVRs have been at certain points in time on particular buyer groups, and DTIs could do the same. But there is flexibility there for the Reserve Bank to change them. They've obviously done that with LVRs in the past. They've said in their consultation around DTIs, they don't really see themselves changing these too often, and I think that's partly why they've set a relatively high speed limit. So of course there is ability for people to continue borrowing at high DTIs. It's just that lending can be pushed into that speed limit. So that allowance that banks have to lend outside the DTIs, just like they have with LVRs now. So if you want to borrow at a high DTI, you can still theoretically. You've got to satisfy the tests around serviceability, that sort of thing, of course. But the key point is there is a speed limit there. There is that option there, and so some of the higher DTI lending can be pushed into that speed limit, which is maybe relatively generous. I don't know. That's a bit of a subjective view there, but that speed limit is relatively high. So yeah, there is flexibility there. I think that the reason for that speed limit is partly also to give banks leeway in terms of sort of quirky situations where, maybe there's a business involved and that is some debt, or maybe the income's hard to judge, that type of thing. So the speed limit around DTIs is partly there for that as well. But ultimately, wherever it's set, they do have some flexibility to change that as market conditions change, just like they've done with LVRs. So, yeah, there could be times though where it is going to bind more strongly when interest rates are lower, and the Reserve Bank has said that as well. So I guess they'll just assess that as conditions change. But I suppose in the short term, it's not going to do much because we're operating well under those limits anyway.
Yeah, you did mention this, but the fact that it's going to be coming with potentially at the same time as an easing with the loan to valuation ratio restrictions from 65% currently for property investors to 70%, that actually is pretty good, because not that long ago we were at 60%. So that's actually a pretty good news story. And I guess the other side of this is that if property values do go down, it's maintaining that stability because you're allowed to have a little less equity. So I don't know whether that's on purpose or whether they know something that we don't, but that does make it easier should there be a dramatic pullback in property values. But the other part, which I find kind of a positive thing, is that it drives people to really focus on their work again, like really focus on productivity, on their incomes. And that I think has been missing from the story for the last probably decade. There's been a shift towards how can we game the system so that we can get more borrowing so that we can buy property, which has good rental income, which we can then leverage off of. Well, that now becomes quite muted. And the focus now is back on, well, let's get your business up and running. Let's get your turnover higher, your net profit higher, your income higher. And those are all probably really good things from a productivity point of view, from a macroeconomic perspective, right?
Yeah, I think this is, I mean, everyone's focusing on the whole thing that DTIs might not do much straight away. I don't want to downplay them at all, because even though they might not do much straight away, I think they're a pretty big landscape shift in New Zealand's lending environment, quite significant actually, I think. And that's why we've been talking about them for so long. And it's ultimately at the hub of it is probably just what you've touched on. They're very different from LVRs, where under the LVR system, if the property market goes up, that creates your next bit of equity, that creates your next deposit, you keep buying. This is very different. It ties it to incomes, and they can't change as easily or as quickly, or maybe they can, but it's harder to do. You actually have to work hard to do that. So and that's how it slows down that buying process as well. If you're already at the caps, then why you buy more property is for income to grow. So yeah, I think it's a pretty fundamental shift. It might not do much straight away, but it is a fundamental shift, and I think it does kind of put that onus back on incomes a little bit. If you want to keep buying property. Hey, how do I get my income up? Do I try and push the rent up, or do I get an extra, do I get a border to my own house, or get that side hustle, or whatever it is? So I think that's arguably a good thing, because, New Zealand's got a productivity issue. We lag behind lots of other countries. So if we can do anything to put a greater focus on income generation, then there has to be a pretty good thing.
Yeah, totally. I was just talking to somebody recently where it was like most of the meeting I had wasn't talking about how they could get into more debt to buy more property. It was about how can we deal with the risks associated with income from a self-employment source? How can we diversify that? How can we grow that? And in the back of my mind, I think I was aware of the DTIs coming in as well. And so I'm just thinking, well, that probably should be the focus anyway. And in the context of financial advice, it's not about just investing in things that grow in value. It's about investing in yourself that should grow in value, which is a function of your income. So it's all one big happy process. So, okay, we've covered a lot of ground, massive amount of ground. So 2024, in summary, we think maybe for the first half, it's going to be a little bit choppy, probably not a lot going on, but maybe around the middle of the year, we might see an increase in liquidity, partially brought about by the change in the bright line test rules, and maybe an easing of the LVR restrictions, implementation of the DTIs, which will be minor. And then maybe towards the end of the year, we could see interest rates fall a little bit more meaningfully. And maybe by then people start to get their sentiments up a little bit more, that ratio of 50% could drop a little bit further, and then it's all on like Donkey Kong. Is that a good summary?
Yeah, I think that's a really good summary, actually. Maybe apart from the very last phrase, I think we probably are looking at a property market that over the long run is a bit more subdued than what we've seen historically. But that whole idea the recovery does continue, but it's a little bit slower than what we've seen in the past. And so, it might not be off to the races again, or any sort of metaphor you want to use, but still a steady kind of upturn. And for me, I guess if there's a key theme or a key thing I'm looking to watch for, it probably is who's buying. First home buyers have been active, investors have been a bit quieter, but things do seem to be shifting a little bit. It might get a little bit harder for first home buyers, a little bit easier for property investors. And the other thing, of course, is interest deductibility coming back in. LVR is a bit looser. DTIs maybe not doing much for a start. Interest deductibility coming back, rents rising. So you're not saying we necessarily see a flood of property investment, but things are just turning. So that sort of relative picture for the first home buyers and investors, I think, will be a key one to watch as well.
Awesome. Well, thank you very much, Kelvin, joining me all the way from Lincoln, Christchurch, New Zealand. So thank you very much for having a chat with me. If people want to follow you, where's the best place for them to follow you, and what CoreLogic is putting out?
But we put out a lot of research publications on our website, corelogic.co.nz. You can see all of our stuff there. I'm on LinkedIn. You just be able to search for me there. And just generally, anywhere you want to look, I think if you Google my name, you'll find a fair few media sort of appearances as well. So that gives you a flavour of what we're talking about. But certainly the CoreLogic website's a key hub, and then the New Zealand Property Market podcast that we release weekly. And it doesn't necessarily have an investment focus, as I say, but it does have a general view of the economy and of the property market, which hopefully keeps people informed, and they can make decisions off the back of that.
Fantastic. Awesome. Thanks again, Kelvin. Appreciate it.
Thank you.